Hello, very good morning to all. I'm back again. Firstly, happy Chinese New Year. Today will be the day 5 of the Lunar New Year. Okay, so welcome to today's Daily Dose of Market Insights by OANDA. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Very good morning. Today will be Wednesday, the 14th of February 2024. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Pardon me. Okay, so before we start our daily dose of market insight, let's have a recap of what happened yesterday. Before we jump into that usual short-term technical outlook on the various cross asset classes. So yesterday was a rather key short-term volatile movement across the global markets. Why? Because of the release of that release of the all-important US CPI data for January that came in hotter than expected. So before we jump into that CPI figure, let's have kind of a quick recap of the performance last night on the US benchmark stock indices. So all the US benchmark stock indices ended in the red, very bearish. So the worst hit was the Russell 2000, negative 3.96%, close to negative 4%. Secondly, followed by the heavily weighted mega cap 7 stocks, which is the Nasdaq 100, down negative 1.6%. Then the SPX down negative 1.37%, followed by the Dow Jones Industrial Average, almost the same magnitude, down negative 3.5%. So if we could look at the heat map of the S&P 500, for sure we see lots of red. All right, okay, conjunction over here. So what we could see over here is that the trigger point is actually due to the rise in that US 10-year Treasury yield. So as you know that for those who follow very closely my daily dose of market insights, in terms of intermarket analysis, where to find that potential trigger point, it all boils down to liquidity of the market. So a liquidity tightening condition, that means how do we know that it's liquid tightening or loosening? By looking at the momentum of the 10-year US Treasury yield. So before I go into the US 10-year Treasury yield, let's look at what happened on the CPI data. So you look at the CPI data over here for US over here. So especially the core inflation over here, I could see that the core inflation rate actually is almost the same at 3.9% stabilized, but it didn't fall within market expecting. So market is expecting to come down much lower at 3.7% year on year. And most importantly over here is that if you look at the similar for the headline inflation year on year as well, markets expecting 2.9%, below 3%, but the actual number came in at 3.1%. But most importantly over here is there's one core metrics, right, that the Federal Reserve is actually monitoring. It's called the US super core inflation. So this super core inflation is actually taking into account of the core inflation rate minus of housing data, because you know that housing data is not considered as services. So this super core inflation, right, if you were to look at, let me share with you my screen over here. Yes, I pull it over here. Okay, so if you look at this super core inflation, all right. Okay, let me expand my screen. Yeah. Yeah, so you see this red line over here, this is the month of March. So you see that this a strong uptick in the super core inflation rate from December 0.3, it actually went all the way up to 0.8% month on month. So that's actually what I call it implies that the services side of the basket, the CPI basket, right, is actually much more elevated than market has been pricing in all along. So with that being said, over here is that the services inflation remains sticky. It's very hard to justify for the Fed to actually be as dovish as what market expect at the start of this year. So that actually kind of saw a US we call it pricing of the Fed Fund futures, because I don't want to use the CME Fed Fund futures, because CME Fund futures right now, it seems to me that they are lagging in nature. So if you go to the CME Fed Fund futures right now, in terms of the pricing expectation of the Fed rate cut, like I did, I mean, for those who join my daily dose of market insight, I will look at how does this expectation change. Because this expectation change will have an impact on the 10-year US Treasury, which have a spillover impact to the rest of the cross asset classes, ranging for FX, stock indices, as well as gold. So we know that for sure the March meeting is more or less being killed off 2 weeks ago by a less dovish FOMC and a strong non-farm payroll data. So the March only pricing 9%. So, but however, the May one, very strangely, the CME Fed Watch 2 is still showing 61%. Okay, so by right, this number was actually down at the around 2 a.m. or 1 a.m. Singapore time, which I'm still awake, is down by about 30%, but I'm not sure why in Asia session there's a bump up of 61%, which should be an error in data. Why? Because I managed to get a screenshot from the pricing based on also Fed Fund futures, but calculated by Reuters. It's from the Reuters platform. So it's actually based on Fed Fund futures pricing as well. So if you look at the May one, the May FOMC meeting, and see my screen over here, it has been drastically reduced to 37%, which was this amount, 37% was actually initially reflected in the CME Fed Watch 2. So I'm not sure what's the error going on over there. And no change is 63%. All right. So what we could see over here is that the expectation has started to actually be pushed down the calendar right now. So the first cut now is coming in June. And if you look at from June onwards, right, so this one is less than 50. So this one don't count as a first cut. So the first cut in June, then after that followed by July, September, November. So if you look at it, it's 1, 2, 3, 4. So it's around only pricing in of 4 interest rate cut to 5. Okay, 4 to 5, or it's slightly or tilt towards 4. Okay, so initially at the start of the year, there was actually a very dovish pricing of 6 interest rate cut, but right now it's being dampened down to between 4 to 5. All right, so with that, right, that actually saw a squeeze up in the 10-year US Treasury yield. Okay, so you look at it over here, the US 10-year Treasury yield squeeze up. All right, so now it's actually squeezed up and broke above Jan high. Okay, Jan high, it broke above Jan high, and the way it broke out, it managed to hold above the 200-day moving average, and right now is coming very close to this 50% and 61% Fibo retracement of that previous medium-term decline from October all the way down to late December low. And right now, this level over here also surpassed 13th of December level. Why? Because 13th of December level, this push down in 10-year US Treasury yield was due to the dovish stand that was being enacted by Fed Chair Powell during that point in time, the December FOMC meeting, and also the very dovish dot plot that they portray right now. So right now, market now is trying to adjust the over exuberant of this earlier initial expectation of 6 interest rate cut, and as well as the earlier expectation to price in the first interest rate cut to take place in March. But all this expectation has started to be dozed off. Why? Because of a very firstly, non-farm payroll data is strong, and followed by a rather hot rather elevated services CPI component based on the latest CPI data that was released yesterday. All right. So all in all, right, if there's a case, right, that means US 10-year Treasury yield could further go into this zone over here at this point in time, the 4.33 to 4.5% level, this area here. So with this going into that area at this into this zone, potentially, right, it lead to a dollar strength coming into the picture. Why? Because the US 10-year Treasury yield, now the premium starts to widen against the rest of the year, both from the 2-year and as well as the 10-year. So if you look at the, okay, so pardon me, the US 10-year Treasury yield, okay, where is it? Yeah, here, the US dollar, pardon me, yeah. So this is the US dollar. So you look at US dollar over here, is that the 2-year Treasury yield versus the rest of the world. That means this is the average I get from the key major economy of Germany, UK, Japan, Canada, Swiss, Aussie, China. I divide them. So you look at it, the US Treasury 2-year yield versus this 2-year yield, the average of again the rest of the world has starts to inch upwards as well. All right, so with that, right, inching upward, showing higher high, higher low, and even there's a, if you look at technically speaking, there's also a bullish breakout from this trend line resistance yesterday that has been acting as a resistance since October last year. All right, so what all in all, what I could see over here is that now it's actually testing the 61.8 Fibo retracement of the previous medium-term decline from 3rd October all the way down to 28th of December last year. So the next resistance will be this congestion area over here, which is confluence with the 76.4% Fibo retracement. So all in all, right, what we could see over here in short term, there could be still some signs of dollar strength that is prevalent in some of the pairs, okay, to watch out for. So all in all, what I could see over here is that the trigger point yesterday, right, was actually due to the, yeah, we know that the US 10-year US CPI data was not as expected by market, but the most important trigger point was from the 10-year Treasury yield that going to inch up higher. Inching of US 10-year Treasury yield starts to push back the earlier dovish expectation of a Fed pivot, which in turn give rise to dollar strength. And also dollar strength also has been negative to stocks as well. And US 10-year Treasury yield considered as a cost of funding. So a higher cost of funding potentially hit the longer duration equity, especially on technology growth equity, which hit the Nasdaq 100, and most importantly, equity that has very weak balance sheet, which the Russell 2000 has. A majority of the Russell 2000 stocks has very weak balance sheet. That means their liabilities more than their assets in terms of value. So that actually explains why the Russell 2000, even not yesterday, even right after the first FOMC meeting this year, the Russell 2000 has going to underperform against the other major stock US indices. All right, so with that, right, let me share with you other news event that take shape. Over here is Japan for sure. So Japan is more on the FX market. Later I'll touch more about the Nikkei 225. We're going to see hit what 35-year high. Okay, so in Japan 225, right after early to the release of the data, the US data. So today, very early morning, the minister that is in charge of currency, which is Masato Kada. He's the vice finance minister sitting inside the Ministry of Finance, which is actually in charge of monitoring FX markets rates as well as the volatility. He did a verbal warning this morning after the dollar yen see a very strong push up yesterday. So be mindful that the dollar yen now is actually approaching a key resistance, and later I'll share with you on the technical chart, which is around this 152 figure level. All right, so there's actually a very strong wording. He phrased it over there. Especially he said that some of the recent rapid moves are in line with fundamental, but some are clearly speculative, that he think that the latter is undesirable. And he ended off the remark saying that authorities, which is MOF, are on call 24 hours a day, 365 days a year, and are always ready to take appropriate steps as needed. That means this kind of very strong verbal language, very indicating to us they are watching the market, the FX market closely, especially on the yen movement. All right, so later I'll share with you what are the key technical levels to watch out for on the dollar yen. All right, so to sum up, these are the key events and news flow that take shape yesterday that trigger that volatile movement in the markets. All right, so now what's next in terms of the short-term technical outlook on the various cross asset classes, so let us now take a look firstly at the FX market first. Let's start with the FX market. All right, so let us start with the euro dollar. All right, so the euro dollar over here. Okay, let me expand my screen. Okay, so that you guys could see clearer. All right, good. So this euro dollar right now, for sure, it already broken below the previous pivotal support that we highlighted at 1.023 level, which is the former minus swing low of 6th of February low, and continue to trade within this descending channel, this minor descending channel in place in 11th of January, and way trading above below the 220 and 50-day moving average. So all in all, what we could see over here is there's still no signs of what I call bearish exhaustion. What I mean by bearish exhaustion is because yes, despite it's oversold, but there is no clear signs like a bullish divergence, like what we see earlier on over here. Okay, there's a bullish divergence where there's a slight recovery in the euro dollar, but at this point in time, there's no clear bullish divergence at the oversold level. Yes, they may be at this point in time it's oversold. There could be a bit of bounces up over here, but this given the lack of that bullish divergence on the hourly RSI, this potential bounce may not gain traction so much on the upside. Then thereafter may resume this short-term downtrend that is in place since last Monday high, which is this Monday high, which is 12 February high, shaping lower high. Okay, and also coming very close to the 20-day moving average, acting as a resistance as well. So for today, right, I will use yesterday's breakout point. So this was the breakout point yesterday that showed the very steep sell-off at 1.0760. So this breakout point on the downside that triggered that downside yesterday, 1.0760, will be my key short-term pivotal resistance for today to flip to a short-term bearish bias on the euro dollar. So also, if you look at the Fibo retracement of yesterday's slide, is 61.8% Fibo retracement as well. All right. So as long as this 1.0760 short-term pivotal resistance holds, we will flip to a bearish bias on euro dollar, with the next near-term support to watch will be at 1.0665. We also confluencing with the lower limit of this minor descending channel, and as well as the swing low area of 7th of November to 13th of November last year that is acting as a support. All right. Only hourly close above this 0.760 will negate this bearish tone to see the next near-term resistance coming in at 1.0795, which was yesterday's intraday high, and confluencing with the upper limit of this minor descending channel as well. Okay, very mixed bag on the sterling dollar. So the sterling dollar still is the relatively stronger major pair against the dollar. Why? Because it still managed to hold above the 200-day moving average despite yesterday's sold offer on the sterling against the dollar, the sterling dollar. But what's interesting over here is that previously it managed to hit that resistance level that we mentioned before we go on a break, the Chinese New Year break at 1.2670, which is the 20-day and the 50-day moving average before that sold off took shape. All right. So given this rather mixed element at this juncture, so I'll rather turn neutral. That means neutrality stance, more like a sideways stance between 1.2670 and 1.2565. Only hourly close below 1.2565 will expose the next support level, which is the psychological level at 1.25 figure level. Okay. We also correspond with the swing low area of 8th of December and 14th of December last year. Okay, so that's for the sterling dollar. Now, Asia Pacific currency, let's start with the Aussie dollar first. So for the Aussie dollar, right, Aussie dollar going to be very, very weak. So if you look at the daily chart, the Aussie dollar, it fails to surpass the 200-day moving average. All right, on since the start of late Friday. All right, and right now, this 0.52 becomes to a pullback resistance. Pardon me. Level around that level 52. Okay, becomes like a pullback resistance. So the next support level to watch, right, will be at this 64.10, 63.90, this area over here at this point in time. And if you do the Fibo retracement, taking from the low of 26th of October all the way to 28th of December, is close to 76.4 Fibo extension level. Okay, so with that, we will be having a bearish bias in the short term time frame. All right, so right now it's kind of testing the 64.50 level over here that we have earlier on. So with that, right, I'll be using slightly below 65.20 level, so 65 figure level. So this level is a short term pivotal resistance that we have today to maintain that bearish bias. Okay, why this level is important? Firstly, it's psychological. Also linked to this minor ascending trend line support now turns into a pullback resistance, this dotted line here. And if I do the Fibo retracement of that entire sold off yesterday, is also close to 61.8 and 50% Fibo retracement. Yeah, we may see a bit of bounce coming into play over here. So as long as this bounce managed to be kept by 65 figure level, short-term pivotal resistance, potentially the Aussie dollar could still see a further bearish bias in the short term. Towards with the next support coming in at 64.10/63.90 as actually depicted on the daily chart, which is the 76.4% Fibo retracement as well of that previous medium term up move. Only an hourly close above 65 figure level will put a damper to this bearish bias. For the next intermediate resistance to watch will be at the range resistance in place since 7th of February, a range, as well as the 200-day moving average also acting as a resistance. So this is the zone 65.40/65.70. Okay, so dollar yen, before we went for our CNY break, we have that bullish bias, pardon me, bullish but not bearish bias, because it broke above 48.80. So with that, right, it really hit 15020, 15070 level. So now it's kind of a very extreme overbought level yesterday. Okay, so I could see over here is it hit a rather extreme overbought level. Okay, so and given that the MOF officials are watching the FX market, potentially there could be signs of pullback. So the key support level to watch over here in this pullback will be there for sure is 14960. Why 14960 is important? So it actually relate to the previous minor range top that has kept it from last Friday and before the release of yesterday US CPI data, and also the pullback the support level of this lower boundary or lower limit of this minor ascending channel that I drew from the low of 2nd of February. All right, so this is an important level to watch. So if any potential pullback managed to hold around this level at 4960, the short-term bullish trend that is in place since 2nd of February still will be remains intact, with the next resistance level to watch will be at 15140 level. So what's 15140 level is the 1.236 Fibo extension that I drew over here. All right, and also if I do a cluster one within, okay, is 1.236 as well. Okay, so the major resistance to watch will be at 15195. So what's 15195? So if you look at the daily chart, right, this level was actually being kind of intervened by the MOF instructing BOJ to do some checking on the FX market. So as well, this is the real intervention, 15195. Okay, then on 13th of November, it tested again. 1st November, 13th November, around 15195. Then before that, sold off took shape, and right now is hitting this level again. So this 15195, also that's previous major swing high area of October 2022 and November 23, and also correspond to this pullback resistance of that previous major ascending channel support that I drew from the low of 24th of March 2023. So that gives rise why this level is a key level of 15195. All right, so above 15195, that means we're talking about the next level will be at 11 to 25th June 1990 swing high at 15510. All right, over here. But given the fact that MOF, the Ministry of Finance in Japan, is looking at the market, checking, monitoring the FX market based on that verbal intervention from the Vice Finance Minister this morning, definitely 15195 is a resistance level that we got to monitor closely as well. All right. So with that, still have that kind of a cautious bullish bias outlook on the dollar yen, with 14960 as a short-term pivotal support level. A break below 14960 for sure will invalidate this move. Then the next support level to watch in the first step will be at 14880/14830, which is the 20-day moving average and the previous range resistance pullback support. Okay, so that's pretty much sum up for the FX market. So overall, what we could see over here is we do from a technical analysis perspective, in the shorter term, potentially there could be still some signs of dollar strength that is still intact based on the chart and elements that I shared with you earlier on. All right, so now let's move on to the indices. So indices, let us start with the Hong Kong index. So Hong Kong index, before we go for our CNY break, so Hong Kong today, the Hong Kong cash market is open today as well after the CNY break on Friday. okay, on Friday. So what we could see is that last Friday we do have this 15,440 short-term pivotal support that we have. Price action managed to show off today's morning, and now is intending to shade that rebound as well from here, the rebound one. So where it bounced, definitely it bounced from the short-term pivotal support, which is important, and also this minor ascending channel that I drew from the low of 22nd of Jan 2023. So overall, right, what we could see over here is that the price of the Hong Kong 33 still remains on support positive in the short term, at least in the short term. This is the hourly chart, and also the RSI has started to shape that bullish divergence as well. All right, but price show lower low this morning, but the RSI start to shape a higher low. Okay, and an exit from the oversold level as well. So as long as this 15440 short-term pivotal with support level holds, still maintain that short-term bullish outlook in this potential counter trend rebound scenario. Okay, so resistance level to watch over here will be a zone. So I'll put in that's the 20-day moving average here. Okay, will be at 16,070 slash 16,250. Okay, this zone over here, which confluence with the downward sloping 50-day moving average. All right, this is the zone to watch out for. So, only an hourly close below 15,440 will damage or invalidate this potential short-term bullish bias counter trend scenario to expose the next support level at 15,300, followed by the psychological level of 15,000 on the Hong Kong 33. All right, so now let us start with the Nikkei 225. So Nikkei 225 it continued to burst up, and is now very fast approaching the all-time high level. So yesterday it actually hit the all-time high level of 38,406. So very closely to 38,957. So that's the all-time high printed in December 1989. So we almost come a full 30-year plus cycle for the Nikkei 225 or the Japan 225. So overall, right, you look at the Nikkei 225 over here. Yes, during the US Treasury is so off, but the way it's so off over here, right, it managed to the so off yesterday managed to store at this dotted green line. So this dotted green line over here, right, is actually the pullback support of this major ascending channel resistance that has been taken out yesterday during the pardon me during the Asia session. All right, Asia session. Okay, so this medium term ascending channel support level that I drew from the low of Jan 2023, it broke out, now turns into a pullback support. Okay, and this pullback support also confluence with the lower limit of this minor ascending channel from the low of 7th of February. All right, so all in all, right, I'll be using slightly lower over here, which is 38,420 as my short-term pivotal support level. So 38,470 short-term pivotal support level still maintain this short-term bullish bias. Next resistance level to watch for sure will be the upper limit of this ascending channel, will be at 38,670 slash 38,780, slightly below the current all-time high level, confluence with the 4.23 Fibo extension that I drew over here, and also a cluster level. Okay, okay, a cluster level as well. Okay, so net that is of 1.236. Okay, so net overall, as long as 38,420 short-term pivotal support holds on the Japan 225, we will still maintain that bullish bias with next resistance at 38,670 slash 780. A break below 38,420 will invalidate this move to expose the 36,880 support level, former minor swing high area of 23rd of January. Below it exposes the 20-day moving average, acting as a support at 36,400, also confluencing with the previous minor range resistance of the 31st of Jan to 6th of February, now turns into a pullback support at 36,400. Okay, the German 30. So the German 30 going to churn in a very sideways range configuration. So it appears to me that since the high of 30th of Jan, it has been evolving within this kind of expanding wedge or expanding triangle formation. So yesterday it sold off, hit the lower limit of this expanding wedge, which confluenced with the swing low of 25th of Jan and as well as 1st of February, 16,795. Okay, so I will use this 16,795 as my short-term pivotal support for today. Potentially there could be a bit of bounce coming to play since it hit the lower limit of this expanding wedge configuration, and also confluence with the 50-day moving average as well. So as long as this 16,795 short-term pivotal support holds, the next resistance, the next near-term resistance to watch will be at 16,950, followed by last Tuesday high before the release of the CPI data at 17,050 level. Right. However, an hourly close below 16,795 will invalidate the short-term bullish bias to see the continuation of this minor corrective decline. Next support zone to watch will be at 16,700, 16,620, which correspond with the congestion area over here of 22nd of Jan to 23rd of Jan, and also the 50% and 61.8% Fibo retracement of the previous up move, minor up move from 18th of Jan to 30th of Jan. All right. Now, US indices. So US indices, let's start with the Nasdaq 100 first. So the Nasdaq very interesting over here is that what you could see, right? This is the October push up. So this October push up, right, is been going to churn up over here. So why Nasdaq important? Because it's one of the leading index so far. And what we could see over here, right? The way it moves out over here is coming very close to, it's already starting to show signs of a exhaustion, where price started to show higher high, but the index starts to show, oops, sorry here, let me delete this. The index start to show higher high, but the RSI has started to print lower high at the overbought level. So indicate to us that, right, the push up here from 8th of January is losing upside momentum. And what we could see over here, right, is actually evolving within a bearish chart configuration as well, while losing upside momentum as depicted by the bearish divergence. So this is what I call a bearish this ascending wedge configuration. Okay, indicate to us that the slope of the higher high is lesser than the slope of the higher low. Okay, so what we could see over here, right, the tip of the end of the ascending wedge configuration comes in at 18,270 level. We also confluence with the major channel upper limit that I drew from the low of 29th of December last year, and also correspond with a Fibo extension level of 0.764, okay, that I projected, okay, from the low of 13th of October. So that's where the start of the current major uptrend. All right. So all in all, what it could mean over here is that in the shorter term, since it's hitting a support level, but this support level, whatever bounce that we could see over here is could be potentially there's a risk of this just residual push up around the 18,270 level before a potential kind of a multi-week corrective decline take shape to mean revert towards the, because right now is exactly close to the 20-day moving average. Okay, so I didn't draw the 20-day moving average. Okay, let me pull up the 20-day moving average for you. Okay, let me draw the 20-day moving average. Oops, 20-day. Okay, so right now it's exactly holding on to the 20-day moving average, right? So there's a risk that it could actually, after there's this residual push, then thereafter there's this potential mean reversion towards the 50-day moving average over here. Okay, so now, so that's for the, we know that the longer picture over here is that we got to be more cautious, but it's still on support level. So if you look at the shorter term RSI, price action actually hit the 20-day moving yesterday, which is our support level initially as well at 17,500 short-term pivotal support. For those guys who actually recall on last week short-term daily dose of market insights. So 17,500. Previously we have the first resistance at 18,000/18,030, which made before that sell-off take shape. So now it bounces off the 20-day moving average, which is so the 7,500 level. And what's interesting over here is that the RSI has started to shape a bullish divergence. All right. So what we could see over here is that yes, a bullish divergence on the hourly RSI, but bearish divergence on the daily RSI. So we got to be a bit cautious right now. Yes, despite the fact that we are the short term is bullish, but longer term is bearish. So it could be just a this push up here could be a residual push up before a higher time frame bearish elements asserts on the Nasdaq 100. That means we're talking about potentially a multi-week kind of a corrective a decline to take shape. So we are taking things one step at a time because it's 5,500. There's still short-term positive element being seen on the Russell RSI, hourly RSI. So we will still maintain that bullish bias, but a very cautious approach right now, with the first resistance to watch at 17,840, followed by 18,030. All right, this zone over here. However, an hourly close below 17,500 will actually negate this bullish view and potentially kickstart that multi-week corrective decline. First support level to watch will be at 17,120 in the short-term basis, which is the swing low area of 1st of February. And also coming close to it will be very near the 50-day moving average as well. Right. So very similar on the Wall Street 30 as well. The Wall Street 30 also managed to bounce off from the 20-day moving average, recapture it. All right. So with that, right, we'll be using this 38,060 short-term pivotal resisted support level, but still maintain a very cautious approach. Why? Because the leader Nasdaq 100 on the higher time frame is start to show signs of bearish elements emerging. All right, indicating to us that the last few weeks of movement, the upside momentum is losing steam. So with that, we do have a bearish bias on the US Wall Street 30, but a very cautious approach. 38,060 short-term pivotal support. The next resistance to watch will be at 38,560. Only an hourly close below 38,060 will invalidate this bearish bias to see potentially kickstart that multi-week corrective decline. 37,800 slash 37,580, which is the 50-day moving average acting as a support level. This zone here, followed by the former range resistance of 29th of December to 12th of January, turns into a pullback support at 37,800. Okay, so that's pretty much sum up for the major the major indices outlook. All of them are still on support, but we do be very cautious, especially on the major US stock indices with the Nasdaq 100, the leader. On the daily time frame, it starts to exhibit a bearish element with that bearish divergence, with that glaring bearish divergence that is being seen on the daily chart of the Nasdaq 100. All right, over here. Okay, so with that, let's move on to oil. So WTI crude oil price managed to hit the upper limit of this range, this triangle-like configuration over here. So it's 74.80. So I could see over here, there's this kind of triangle-like configuration that's been trading since the high of 14th of November. Okay, so it hit that upper limit of that level. So with that, right, we'll be using this 78.40 as a short-term pivotal resistance level to watch. First support level 76.90, followed by this Monday's swing low area, which also confluence with the 20-day moving average. I think I support at 75.75. So as long as 78.40 holds, potentially there could be a chance of a short-term bearish bias to retrace this up move that has taken shape from 5th of February. All right, over here. Okay, however, an hourly close above 78.40 will invalidate this short-term bearish bias to see the continuation of this a complex rebound configuration within a range to test the minor swing high area of 14th of November and 13th of November at 79.80. Okay, now lastly will be gold. So spot gold yesterday broke below the psychological level, 2015 and 2000 level, and it's going to push downwards. Why? Because spot gold itself has an indirect correlation with the US 10-year Treasury yield. Because think of the way that for US, spot gold itself is non-interest yielding asset. So with the longer term US Treasury yield increases yesterday, the opportunity cost of holding gold also increases as well. So that actually explained this down move that was actually the sharp down move that was seen in gold yesterday, XAU/USD. So it broke below the 2000 psychological level. So there's no signs of exhaustion on the downside. That means there's no clear bullish divergence on the hourly RSI. So yes, the hourly RSI now managed to actually because there's nothing price going to push down. there's no bullish divergence. If you look at it over here, the price going to show lower low. Okay, so yes, it's oversold, so potentially, right, there could be a bit of bounce over here. So as long as this bounce didn't actually surpass the breakdown point yesterday, so this is the breakdown point yesterday. Okay, why breakdown point? Very obviously, previously was a minor low, minor low was supported, then pump, it break down. So also correspond to the 50% Fibo retracement as well. Okay, so as long as the potential bounce didn't surpass 2013 spot goal, there's a risk of it to see the continuation of this decline. That means we will have a short-term bearish bias. Next support level to watch should be pretty much important support level. Why? Because it's 1975. So this 1975 was December 13 December low and 11 December low. So this 13 December low, notice that you see a V-shaped spike up. So why cause this V-shaped spike up was due to the FOMC at that point in time, where the FOMC kind of triggered that dovish guidance on that Fed pivot, and as well as the portray of a dovish stance portrayed by Fed Chair Powell at that point in time as well. And also 1975 is also very close to the 200-day moving average, also acting as a resistance at support at 1965 level, very close. All right, so it's a zone 1975, 1965. Okay, so only an hourly close above 2013 will invalidate this short-term bearish bias on gold to see kind of a recovery back towards the 20 and the 50-day moving average, and so confluencing with this minor range stop of 8th of February and 9th of February. So that's around 2030 and 2036. So that's the next resistance level to watch if 2013 is being surpassed on the upside. All right, so that's pretty much sum up for today's short-term technical outlook on the various cross asset classes. So before we go very quickly, what other key data to look out for today? So for today, right, we do have inflation data, but not from US, but from UK. So UK inflation data, the core inflation market is actually expecting a slight uptick from 5.1 to 5.2% year on year for Jan. All right, so if this data came in with expectation, that could be support a bit of so-called sterling against the dollar. So that actually explains also why the sterling is the strongest major currency that is holding still firm above its 200-day moving average against the US dollar. Then after that, we do have this okay, so is this not so important because this unemployment GDP growth rate is the second estimate in Eurozone. And what we could see over here is we see a slew of Federal Reserve officials speaking. So what we could see over here is that we have ECB officials speaking, Kelvin at 10 p.m. Then followed by 10:30 p.m. Another Fed officials, Fed Goolsbee is speaking as well. Then after that, early morning, we do have at 7:50 a.m. before we start our daily dose at 11 a.m. We have Japan preliminary Q4 GDP growth rate, then followed by Australia job market data, which is they call it the employment change data, out at 8:30 a.m. Singapore time tomorrow. Okay, so that's the key data to look out for in this following session later on. So with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.